One day, a 1,437-point plunge, and then the very next day, a 924-point surge. So what is actually driving this extreme market whiplash?
Hello everyone, welcome back to AI Market News. Based on available data, what we are seeing right now is a historic tug of war in the markets. On one side, we have an incredible comeback in chip stocks pulling equities higher, but on the other side, they are fighting directly against elevated geopolitical risks that are threatening to pull everything right back down. Today, we are going to break down exactly what is happening and what it means for all of us navigating these markets.
As you can see in the chart displaying the S&P 500, Wall Street's technology and semiconductor names rallied incredibly hard. The major catalyst for this was Apple. They announced an expanded, multi-year partnership with Broadcom worth a massive $30 billion for custom chip development, and Broadcom shares absolutely jumped on the news. Separately, reports emerged that Chinese authorities will allow domestic AI companies limited access to purchase Nvidia's H200 chips. Nvidia gained on that news, which ended up pushing the broader semiconductor index significantly higher.
Now, if we direct our attention to the graph here showing the Japanese market, we can see how that momentum from the US carried directly across the Pacific into the trading session. AI and chip-related names led a broad and very powerful rebound for the Nikkei 225. This effectively snapped its recent skid and helped restore some much-needed confidence for Japanese investors.
Let's briefly explain the underlying mechanism here for those new to these dynamics. Why exactly does this trans-Pacific tracking happen? Well, Japanese tech companies, particularly the ones manufacturing semiconductor equipment and materials, are supplying the exact same global AI infrastructure build-out as US firms. So when US tech rallies on strong demand signals, Japanese suppliers naturally catch a bid the very next trading session, because their fundamental growth story is just so closely linked.
However, according to current market information, it was not a purely positive day across the board for all of us. The Dow Jones Industrial Average actually fell quite sharply, dropping 576.76 points. This was primarily driven by geopolitical fears. President Trump raised the possibility of further strikes against Iran, which immediately reignited fears of renewed conflict, sending a shockwave right through the broader non-tech segments of the market.
The graph shows exactly how those geopolitical fears rippled into other asset classes. We saw climbing crude oil prices on the left and rising US 10-year Treasury yields on the right. The core mechanism to understand here is that rising oil prices feed directly into higher inflation expectations. Furthermore, the hawkish FOMC minutes released that evening reinforced the case for yields staying elevated, which kept bond markets on high alert even as tech equities tried to stabilize.
Moving over to the currency markets, looking at the chart, the USD/JPY had a very eventful intraday session. Driven by those oil-linked inflation concerns and a flight to the safe haven dollar, the pair touched 162.709. However, it quickly pulled back to around 162.419, and right now, it is settled into a tight, range-bound standoff in today's Tokyo session.
The mechanism behind this currency standoff is a classic market battle. We are witnessing crisis-driven dollar buying as investors seek safety from Middle East tensions, fighting directly against intervention-wary yen buying. Market participants are highly cautious that Japanese officials might step in to support the yen near these recent highs, effectively capping how far the dollar can run in the near term.
Turning to market sentiment, this graph illustrates the VIX, widely known as the Fear Index. After an initial spike driven by that geopolitical shock, it has actually cooled off, easing back down to 16.96. What this illustrates to all of us is that rather than panicking, markets are digesting the worst-case scenarios and shifting into a wait-and-see posture, carefully evaluating the actual economic impact of the headlines.
Before we close, let's look ahead at the economic calendar to see what can move markets next. Later today, all times Eastern, we will see jobless claims at 5:30 a.m., followed by existing home sales at 7 a.m. But the most critical release for all of us to watch is next Tuesday's July 14th CPI report. This will be essential for gauging whether this recent oil-driven price pressure is actually filtering down into consumer inflation.
Putting it all together, the current market regime is a high-stakes tug-of-war between Middle East geopolitical risks and relentless enthusiasm for AI infrastructure. Both of these massive macroeconomic forces remain actively in play. Seeing a four-figure point move in either direction in a single session is a stark reminder to all of us to size our positions carefully and manage risk appropriately given this environment. So the ultimate question we are left with is, which force will break first, the geopolitical tension or the AI boom?
Thanks for watching. Please subscribe and hit the like button.
This explainer was automatically generated by NotebookLM AI. AI-generated content may include errors. This explainer does not constitute investment advice. For full details, please check the description below.